If you are a director of a limited company, you have an important decision to make. You see, company law requires accounts to show a true and fair view, and tax legislation says that accounts must be prepared using generally accepted accounting practice. So, what is the problem? The problem is that generally accepted accounting practice has changed, and it is now possible that accounts prepared using generally accepted accounting practice do not show a true and fair view. Up until the end of last year, there was just one accounting standard that applied to small companies, the Financial Reporting Statement for Smaller Entities, affectionately known as the FRSCI. And you, as directors, signed the balance sheet under the following statement. These accounts have been prepared in accordance with the provisions applicable to companies subject to the Smaller Companies regime, and in accordance with the Financial Reporting Standard for Smaller Entities. Sadly, the FRSCI is no more. It has ceased to be. In its place, you now have a choice. Option 1, which is FRS 105, and Option 2, which is FRS 102, Section 1A. So, which one would you choose? On the face of it, it seems quite simple, because you can only use Option 1 if at least two of the following apply. Your turnover is 632,000 or less. Your balance sheet total is 316,000 or less. Your number of employees is 10 or fewer. Option 2 takes the limits up to turnover of 10.2 million, balance sheet total 5.1 million, and employees 50. So you would think if you fall within these parameters, then the obvious choice is Option 1. But that may not be the case. You may be better selecting Option 2. But why? Let us look at Option 1 in more details, the advantages and disadvantages. Let's begin with the advantages. The accounts are simple and straightforward and presumed to give a true and fair view. They are in fact so simple that there's less than a page of information sent to Companies House. They are prepared on a similar basis as they are now, and so accountants' fees should remain fairly static. And it is possible that you would pay lower tax than you would under Option 2. However, there are some very major disadvantages. No revaluations are allowed. That means assets are stated at cost. If you have had revaluations in the past, you could find tens of thousands or even hundreds of thousands written off your balance sheet. This would most likely mean you would end up with a lower credit rating. And certainly because of the minimal disclosure at Companies House saying very little about your company, you are also likely to have a lower credit rating and therefore find it difficult to obtain credit and finance. And a bit of a paradox, it's also possible you could end up paying higher tax than you would under Option 2. But if you go for Option 2, there are things you need to be aware of. The accounts are more complex, and there are more disclosures to make than under Option 1. The accounts are not presumed to give a true and fair view, and so you may have to make other disclosures or encouraged disclosures. And as mentioned before, tax may be different to option 1, which could be higher or lower. And because of all this, because of the extra complexity, accountants' fees are likely to be higher. So, to sum up, it is the director's responsibility to ensure the accounts are prepared using generally accepted accounting practice and show a true and fair view. Generally accepted accounting practice has changed, and the directors need to make a decision. The decision is not straightforward, but the accountant can only advise and point out the potential consequences of each option.